This is Forum 3A, Portfolios of the Future, a tale of three innovative investors. My name is Andrew Boal. I'm now 4 months into my new role at Rice Warner and pleased to be here at the ASI Conference 2019 and chairing this session. We're going to get you through to lunch today. About 10 years ago, we started talking about lower interest rates and lower returns for longer. Thinking that might go out for 4 or 5 years, and some pessimists at the time were thinking that might even last for 10 years. That was 2009. Interest rates had the 10-year bond rate in Australia had just dropped to 4%, and there was really not much opportunity for it to go any lower. 10 years on, it's now dropped below 1%, and we're talking about being lower for even longer. And probably with the 10-year bond rate at below 1%, the 2-year bond rate I think is at 0.7%. So certainly a lot of expectation in markets that we're in a low interest rate environment for many, many years to come. So where do investors find future returns? What innovative opportunities are there out there to get extra returns from your portfolios, and what are the risks associated with those innovative approaches? So today we've got three panellists here to talk us through some of these opportunities. But before we get to that, we have a polling question. So if you haven't already opened up the app, please do so now. I'd love to get all of your participation both through the polling question but also through question and answers later on in the session. So what do you think is the biggest challenge in building a portfolio of the future? Sitting here right now. Income growth, ESG integration, returns, and I think that should mean net returns, risk, specified as downside risk in particular, or cost. Be interested to see what people come up with from that. There's a lot of issues floating around just in those questions. So whilst you're doing that, I'll just briefly introduce the panel. All the details are in the app, so you can see their full bios. We have 3 speakers today. Our first speaker is Scott Bennett. He's the Head of Quantitative Research and Client Solutions for Northern Trust Asset Management, where he's responsible for the development and support of Northern Trust's quantitative solutions across both Australia and global equity markets. Our second speaker will be Tanya Branwhite, who's the Head of Portfolio Construction at New South Wales Treasury Corporation, and she was recruited in there in December 2018 into a senior leadership position as the Head of Portfolio Construction, and previously was also at the Future Fund, where she was a Director of the Listed Equities team, and most recently there was the Director of Market Insights and Portfolio Implications, so very experienced in this area as well. And our third and final speaker is Rishabh Sethi, who's a portfolio manager for external investments and partnerships at the New Zealand Superannuation Fund, with responsibilities for investment opportunity evaluation, external manager selection and mandate design. He's also previously worked in asset allocation and corporate strategy roles for the New Zealand Super Fund. So, have we got the results for the question? Maybe that was due to my setup, that where are we finding future returns in the future world? But importantly, I think that's the second place there is looking at downside risk and how we look at new opportunities with that lens as well. Cost is not a big issue. Any thoughts from the panel? Scott, what do you think of those?
Apart from they're lacking all of the above type response, I think that, definitely when we speak to asset owners globally, I think the emphasis is really on returns and downside risk. Increasingly, as we get ageing populations, the notion of income growth in a effectively no-income environment is something that's front in mind for a lot of asset owners at the moment, in terms of how they not just provide income but actually make sure that income's actually growing through time. So looking just beyond yield but actually driving higher income levels to support retirement is a big issue that we see.
Tanya, any thoughts?
Well, I think it's actually, interestingly enough, the question is building a portfolio of the future. Returns are an outcome. So I think the biggest challenge in building a portfolio of the future is making sure that you know what risks you have and looking for the diversity in terms of constructing that portfolio. So Returns obviously are a challenge, but they're an outcome. They're not something that anyone can actually control. We're receivers of returns. I think risk management is the biggest challenge of building a portfolio and looking for the diversity of outcomes through that risk focus. That's the biggest challenge to build a portfolio.
Yes, so building the portfolio, balancing all of the risks so that they counter each other and the returns will be what they will be. And finally, Rishab?
I think the only observation I have is that the results here probably seem no different than if we had asked ourselves this question 3 years ago or 5 years ago or maybe even 10 years ago. So we're clearly very worried about it, but we seem to have done all right in the interim anyway.
Yeah, it's a good point. Okay, so we've now got the app is now open for Q&A, so you can start to put your questions in. So it's the AXA Investment Managers live Q&A. So go in there as you hear the speakers present. Put your questions in as and when we go through the session so that you don't forget them. And we'll now ask our first speaker to go to the podium for 15 minutes. Thanks, Scott.
Good morning, everyone. So I thought in terms of talking about portfolios of the future, it might be worthwhile just to set the landscape for what the future might actually look like. And at Northern Trust, every year we release our capital markets assumptions, which really sets out our expectations for different asset class returns over the subsequent 5 years. When we do that, we see generally 6 key themes emerging every year that we think actually drive those assumptions. And actually within the app, we've got a detailed report on what those capital market assumptions are if anyone wants any greater detail. But in terms of what we're expecting over the next 5 years in terms of major investment themes, there's some commonality amongst these themes, but what we're seeing play out with a lot of the trade tension we're seeing around the world and this kind of move towards more nationalistic structures is a really big change in terms of global supply chain. So global growth is restructuring. So instead of offshoring, we're going to see a lot more onshoring of production and manufacturing. And that's going to be driven predominantly through technological change. So that technological change is actually going to result in more automation in terms of the manufacturing processes. And that's actually going to dislocate a lot of different parts of the market as we go through that slow but very painful process. As we start to see that increased automation and increased focus on technology, we're expecting inflation rates not to really move too much from where we've seen them over the last 4 years. So we're in an environment where we've actually effectively got low interest rates but actually very, very low inflation. So we're in a moment where none of the major economies are actually hitting their inflation targets despite yields being at record lows. So this creates an effective conundrum for what growth looks like going forward, and in particular what monetary policy looks like going forward in terms of actually stimulating growth within the economy and getting that inflation rate up. And so we think that when it comes to monetary policy, which hasn't really been that effective in stimulating growth and inflation through the world more recently, we're going to see monetary policymakers work more in tandem with governments and fiscal policy to actually drive up inflation and further that growth. So that's going to mean that the traditional policy levers are going to look different going forward than what they have in the past. And I think there's a good session coming up later today, which is looking at kind of some of the implications of China and the US and the trade wars going there. We don't see that a resolution to those trade wars happening anytime soon. If anything, we think that they'll maintain highly escalated over the next 5 years. If anything, we think that there'll be periods where it'll look good and periods where it'll look bad, depending on what tweets come out at 2:30 a.m. in the morning. And then on the other side, or related to that, is a key theme around executive power play. We think this is going to be really important in terms of the types of volatility that we'll see in the market. So increasingly, we're seeing more polarised political parties, and within that, more polarised political policies as well. If those the more polarising those policies are, we think that'll lead to greater volatility within the markets and less certainty as well. And then finally, a key theme that we'll continue to see play out over the next 5 years is really this transition away from fossil fuels towards renewable energy, which is already underway, but we're really starting to see that come through in terms of company balance sheets and also in terms of where we see infrastructure investments as well, so investments in renewable and green infrastructure. So to sum up, The world that we're painting over the next 5 years is one of low growth, low inflation, relatively low returns, but very, very high volatility. And within that, we think that with increased volatility in the discussions that we're having with asset owners around the world, the key emphasis is on managing risk within the portfolio and how we do that effectively. So I'm going to share two perspectives of portfolios of the future. I'm going to share some of the insights that we get from the asset owners that we work with, not just here domestically, but also globally. And then I'll give a bit of an insight in terms of what we're seeing from the asset management community, even from our own asset management offering. But when we look forward to the portfolios of the future relative to where we've been in the past, we're in an environment where we've effectively got multiple objectives. So instead of having a single objective in terms of maximising balance for when someone retires, we've actually got investors within the same pools that are intergenerational. And so within that, you've got people that are just entering the workforce. You've got people that are actually well established into their savings plan and actually planning a transition to retirement, and also those people that are actually entering into a retirement. And if we think about some of the polling questions that came up before, these are the multiple objectives that everyone is actually having to face. So this notion of actually all of the above, everyone's actually having to deal with all of those issues at the moment, and it's not just about maximising a particular level of return, but it's about achieving multiple objectives around cost, around ESG integration as well. Another big theme that we're seeing emerge, I think this is really coming out of more Europe and also American markets, is this notion of journeys versus destinations. And if we think about life cycle products, which have been a very effective move away from destinations but actually managing journeys, I think we're going to see major developments in this space over the next 5 to 10 years in terms of what portfolios look like. It'll include the incorporation of machine learning, AI or contextualised modelling, but this notion that everyone retiring in a particular year should have the exact same portfolio will get much more nuanced. We'll start to look at what people's contributions are, what their income is, all of this information that we actually readily have and collect, and that will start to be used to actually build more contextual portfolios. And that means that we'll not just be looking at average returns and average risk, but we're looking specifically at the risk and the returns that are relevant to each individual member, and that'll be done through the use of AI. And there's a lot of exciting fintech companies coming out of the US that are already developing that type of technology. The third one, and we're already seeing this a lot, but increasingly the notion of values and virtues. And so values are really about asset owners representing their underlying members' constituents and collectively their values within their own portfolio construct, but also we're seeing increasing regulation around expansion of fiduciary obligations to include things like ESG. We have much greater transparency than we've ever had in terms of what the underlying investments are, and we have a consumer, not just on superannuation side, but just more generally, that is much better informed and much more targeted at matching their consumption behaviours with their own values. And superannuation and asset owners are going to have to respond to that by actually making sure that those portfolios are aligned with the underlying members' intentions. So these are kind of some of the challenges that we see from asset owners around the world. I think the one common thing we see from more progressive asset owners in terms of how they go about combating this is really about developing very, very strong aligned investment beliefs. And I kind of consider investment beliefs as being effectively the platform that you can actually tackle these problems. So those investment houses, and Tanya and Rishab can talk a bit about their own book in terms of what they're doing at their respective organisations, but those firms and asset owners that we see that have well-articulated, well-codified investment beliefs are actually much better able to actually account for multiple objectives, manage journeys over destinations, and incorporate the values of the underlying members, but also more broadly these expanded fiduciary duties. So with that as a backdrop, what does that mean for the asset manager and the types of products that we'll see going forward? And I think increasingly what we're seeing is from the asset management community, it's not about being a product provider anymore, it's actually about being a partner. And this is about effectively working with clients in terms of setting the investment objectives and leveraging both the insight at the internal investment teams of the asset owners with the capabilities of the asset managers. So increasingly, and we're seeing this within our own organisation, it's about working hand in glove with the underlying asset owner and client in terms of making sure the solutions that we're delivering are relevant and actually achieving more than just one goal, which is aiming to maximise that return. The second key bit, and I think Tanya mentioned this in her opening remarks, is differentiating on risk. So to the extent that the returns are effectively what we receive, and we saw a session yesterday that looked at domestic equities and global equities, which was very focused on returns. But what we're seeing more and more of from the asset management community in response to the requirements of asset owners is a differentiator on risk. And that's in terms of what's the marginal contribution of risk to a strategy, to a complete portfolio, and then also how does the strategies that I employ interact with other asset classes that I might have. So we're seeing an overall emphasis, especially outside of Australia, on de-risking equity asset class, so moving into more low volatility or minimum variance type products. But interestingly, in doing that, we need to kind of take into account other risks that we might be introducing. So making sure that we're not just creating a bond proxy within equities, but that we're actually creating something that's lower volatility on its own, but also has a lower marginal contribution to risk at the total portfolio level. And I think, importantly, that's where we'll see more of the discussion going forward. And even going back to the session that we saw yesterday in terms of equity markets, with a large majority of the asset managers underperforming in Australian equities over the past 12 months, it's really about making sure that as we go through these structural changes of low yields, that managers themselves have the ability to actually manage a lot of the risks that they generally might not have had to have managed before. So I think what we'll start to see is, for a lot of stock pickers, increasing use of risk models or increasing management of risk within their portfolios. And then finally, ESG integration, and this is really full integration. So we've kind of gone through a phase of effective exclusions, but I think asset managers are increasingly being a lot of pressure to actually include ESG considerations as part of their overall return model, and also a bigger requirement to actually engage with companies on a lot of these issues. And so from our perspective, what we see is that to accommodate a move from being a product provider towards a partner, having a greater emphasis and focus on risk, and much greater detail in terms of ESG integration, we're going to see greater use of more systematic or systematization of investment processes going forward. So that could be from traditional stock pickers actually including more risk models or more data into their underlying processes, and also from passive managers actually becoming much more active in terms of what they can do within a passive portfolio. So we see that from a lot of index managers in terms of the way that they're engaging with companies on a lot of ESG issues. And as we move forward, I think 5 to 10 years from now, it'll be very hard to differentiate what's a truly active product versus a truly passive product, and we'll start to see a blending in the middle, which will start to look more like systematic strategies. And I think that's something that we're seeing an increasing trend from asset owners, not just here in Australia, but also globally. So with that, Andrew, I might hand back.
Okay, thank you. And I think we'll go straight across into Tanya.
Thank you, Scott. So I'm delighted to have the opportunity to speak to you today and to share some of the thoughts and reflections from the perspective of my current role at TCorp as Head of Portfolio Construction, but also as drawing from my career experience, which is now, unfortunately I have to acknowledge, heading beyond 3 decades. I think what's really interesting as we're discussing the portfolio of the future is to really think about what's occurred over the past and what we're learning from that. I think the deepening of investment thinking, certainly over my career, theory, and certainly the increasing means of investment implementations, I think this is where we might be really focusing on what the portfolio of the future is going to look like from today's point of view. So you might be expecting that I'm going to evoke, and you've already heard Scott talking a little bit about this, evoke some of the benefits that the application of some of the new technologies like artificial intelligence, big data mining, what that may bring to our thinking about portfolio construction, and certainly the opportunities that may be being suggested as a result of mining that data and the return edge that they may give you. So, of course, that's all fairly exciting, and we're also hearing a lot more about complexity in investment strategies, and some are absolutely suggesting that that's going to be required in order to construct the portfolio of the future. And I would certainly acknowledge that there's no doubt that the environment in which we find ourselves is certainly more complex perhaps than it would have appeared to the past. Our industry is absolutely being disrupted, and I would actually suggest being restructured through data and technology advancement. And that complexity that we're having to deal with and the benefits of technology certainly may offer significant benefits to investors and investment portfolios. And certainly while I think at TCorp we accept that these developments are really something that we're living through and offer benefits, perhaps I might disappoint you by saying that I think the successful portfolio of the future does not necessarily have to be built only on those perspectives. That's not to say that I think high quality data and efficient use in its purpose and application to our portfolios is not critical, because ultimately what we're seeking to do is to have better and more insightful real-time support for the decision making. But the point that I would like to contest today is that that's not necessarily as the only thing that is going to require a successful portfolio of the future. So perhaps I'm going to be a little bit more conventional by suggesting that success for the portfolio of the future actually rests upon things that we actually already know. So I'm going to suggest that the imperatives of a portfolio successfully constructed for the future really relies on three key things. That is sound and aligned governance structures, an investing organisation and team that has a healthy and effective culture and really leverages from the benefits of that team, and that these are the critical enablers of an investment model which is actually focused on the whole of portfolio outcomes. Whole of portfolio thinking considers the portfolio certainly in our perspective from risk exposures, and these risks are understood and that they are actively accepted, and that we strive for a portfolio outcome that delivers on our clients' risk appetites. So I'd like to talk about each of these three things. I really want to unpack these things because these are really critical. Perhaps what I've just said is really not potentially sounding revolutionary, and in fact sound principles implemented well rarely are. But at TCorp, as we're continuing to evolve our role as the financial markets partner for the New South Wales Government and the New South Wales Government family, in management of those assets, and certainly the stewardship that we understand that we have with over $100 billion of the people of New South Wales assets under our care, we're certainly really aware of the importance of governance. And it's these responsibilities and it's this governance that I think is one of the key things that I'd like us to consider today in thinking about the portfolio of the future. As you can see there, I've set out governance is really defined around mission clarity, investment beliefs. So again, you can hear there's some similarities here coming through what Scott's already put forward. And the quality of board and management engagement. And it's really interesting because I come from a listed equities background, and if I consider successful companies, in fact, much of the governance of successful companies seems to be echoed here through the governance of portfolios and investment organisations. And perhaps in reflecting upon that, it's interesting if you look at any of those who are supposed experts in this space, people like Keith Ambakshire, Roger Irwin at WTW, they talk about the challenge of investment organisations similar to those of boards for companies. And so without mission clarity and without a clear and aligned understanding of investment beliefs, and without really good quality of board and management engagement, then certainly the portfolio of the future, we believe, is not likely to be successful. Now, I will talk about the investment model because there's no doubt an investment model is a key critical component of the portfolio of the future. And certainly our focus, and TCorp is at the moment in transition in the way in which we think about how we undertake our investments and the way in which we think about the stewardship of the capital that we have. And I'll talk a little bit more about this in a moment, but we're certainly moving down the view of a total portfolio approach, and very much that's focusing on risk and risk budgeting, factors, stewardship and the long horizon. And I will come back to that in a moment. Now, I have to also acknowledge the heritage of my role before TCorp, which was the Future Fund, and perhaps I'm reflecting or channeling much of my experience at the Future Fund when I speak about the investment model in that frame. But I'd certainly say, in having started to understand the different investment models that are employed around our industry and around the world generally, I'm absolutely convinced that the portfolio of the future must be based upon and rested upon a total portfolio approach. And the one thing, and not everyone here was at the previous session, but it was interesting when I was reflecting on what was being discussed about diversity in our industry, is the importance of culture. And I think we can talk very much around what's going on in our world and all the potential opportunities and all the information and everything that we're really having to deal with, and yet we don't actually talk about the organisational construct and the way in which we bring the intellectual capital of our organisation together in order to ensure that we have the best possible chance of delivering on the mission for our stakeholders. And so an effective culture is an absolute critical element of the portfolio of the future. Strong leadership, supporting and rewarding teamwork that's aligned with the strategy of our stakeholders, and that it is diverse and inclusive, focused on a sustainable outcome. So how do I unpack that into a little bit more detail for you? So let's talk about portfolio construction. So let's talk a little bit more about the technical aspects of what we have to do. I find it really interesting that we're still, in many ways, in our governance and our engagement, continue to talk purely about asset classes as if they are the best way to think about our portfolio construction. The problem with asset classes is that they are, let's say, a convenient way in trying to think about how we make decisions in our portfolios. But ultimately what we're doing in portfolio construction is trading off decisions around risk. What risks we're prepared to take, and are those risks actually going to be rewarded? And of course, risk is certainly multidimensional, and there are major hierarchies of risks. But I am surprised in my journey particularly over the last 6 or 7 years, is to hear the conversation about expected returns. And yet returns, as I said in my opening remarks, returns are not something that we control in any way, shape or form. We're a receiver of returns, we are not dictators of returns. And when we think about portfolio construction, certainly the way in which we're at TCorp and in the portfolio construction team specifically, is thinking very much around what sort of risks do we have? Are these risks we are actually willing to embrace and accept? Are they attractive for the amount of risk we're taking on? And most critically, do they align with the risk appetite of the various stakeholders? It's probably worth just reflecting for you, for those that may not be as well familiar with TCorp as certainly I am in the last 6 or 7 months. We actually manage over $100 billion, but we're actually managing somewhere around 15 or 16 different portfolios. And those portfolios have very, very diverse objectives, time horizons. Some are liability aware and return sequencing sensitive. Others are simply return seeking. And so when you think about that, you have to really think about not so much the complexity of those missions, but how you make sure that your decision-making is aligned for those, and that our decision-making is ensuring that we are placing the capital of those portfolios in the best possible way. And so we really are moving away from not thinking about assets and asset classes per se, but very much specifically around risks. And some asset classes may be reasonable proxy for risks, such as perhaps listed equities, but then other asset classes are very diverse in their risks. They're very rich in those risks, and so can be very valuable in terms of trying to construct a portfolio that's actually really focused on risk efficiency and getting the best possible returns per unit of risk embraced. So in thinking about that, and I think Rishab will talk a lot more about this in detail, is risk factors, risk budgeting, and replacing assets and asset allocation for risks and risk thinking. So the TCorp approach that we're moving to is very much around thinking about what sort of risks. And when you sort of say that, well, certainly, is that not what we do all the time? But there is so many now dimensions of risk that perhaps were always there, but we weren't necessarily able to really understand those. And of course, data and technology is really helping us significantly with understanding how risk factors and risk budgeting needs to be undertaken. So we're developing a strong framework around that. And data and systems support in terms of that decision making is critical. And this is where I would say that technology is a real benefit to the portfolio of the future. And having great risk systems and risk information and in understanding of your portfolio and its dynamics are critical enablers of decision making. But I think the piece that's perhaps not often referred to or really is well recognised as key to a successful investment organisation and the portfolio of the future is the investment team that collaborates and focuses on the total portfolio. And if you don't have a team, if you think about what we actually have within any organisation, it's the intellectual capital, and that intellectual capital and benefiting and leveraging that intellectual capital within the organisation is the critical enabler. I think if you had the first three of those cogs in the wheel, you would not necessarily have a successful organisation of the future. And so by having these things working in tandem, they are absolutely likely to enable that critical, the portfolio of the future's success. So if I wanted to round out on how this should all come together is clear mission and client-centric. All of these aspects of our portfolio and our portfolio construction and thinking need to be absolutely clear on what our mission is and clear on what our client centricity needs to be, and ensuring that the mission that we've been given is best positioned to succeed. We really appreciate, and I think this is when you work in, I think, the realms of government and understanding the stewardship and fiduciary responsibilities that we have, driving sustainable outcomes, because the portfolios that we manage in some cases will live well beyond even our current stakeholders, but actually intergenerational. And the Future Fund was certainly clear experience of that, and at TCorp we also have a number of funds the New South Wales Government has put as intergenerational capital for the benefit of the future. And so understanding that and the outcomes over the long term and thinking in that long-term perspective is critical. And then finally is the issue of diversification of our thinking, diversification of risks, and ensuring that we are actually seeking not so much the highest returns, but that we're positioning our portfolio and our construction thinking to actually generate the best risk-adjusted returns. And I round back out that the only way we believe we can do that for the future is thinking about the whole of portfolio and where we actually allocate risks across that portfolio. And certainly understanding that sometimes you can take outsized risks in a total portfolio approach to benefit the whole of portfolio. And so diversifying those risks at the total portfolio level, we believe, and I certainly see there's very clear evidence of those organisations around the world that have actually implemented this way of investing, really does deliver the highest risk-adjusted returns. So I look forward to your questions and discussing this further in the next component of the presentation.
Right. Thank you, Tanya. Well, Rishab, we'll hear from you as our final speaker before going to Q&A. Just remember to keep pumping those questions through on the app. and also rate the session through the app at the same time if you're getting to that.
Gosh, thank you for having someone from New Zealand here. In fact, the organisers must have been so excited that they wrote New Zealand twice in brackets as well, just to make sure that you really knew. The theme for the session is innovation, and when I kind of like look back, the things that we do, the things that we have done, they don't actually seem especially innovative, to be honest. They seem obvious solutions to the obvious problems. And I think that's one of the key messages that I would like to get across today, which is that we become used to innovative ideas pretty quickly, and then it's just the way that things are. The next bout of soul searching and navel gazing begins. So what I really want to do is start with a couple of personal messages, and then take you through maybe 2, possibly 3, depending upon time. Practical examples of how we have sort of like implemented some of the ideas that seemed certainly innovative at the time. But the main message, perhaps just echoing what Scott and Tanya have said so far, is that nothing matters more than good governance, good structure, and good culture. So you want to be pretty thoughtful when you start tinkering with that. These things are essential to enabling innovation and shouldn't actually constrain it. The other thing is that innovation isn't always fast-paced. It doesn't always arise from light bulb moments. It isn't usually of the move fast and break things variety. It can require changes to philosophy and mindset, which are difficult to achieve. And by rights, they should be difficult to achieve. There are sort of like, few truths in investing, but I think we can all sort of like agree that if we are changing our philosophies with the winds, we're rather unlikely to be successful in any of our endeavors. So with that, let me perhaps give you a very quick background on the New Zealand Superannuation Fund, sort of like, what our institutional purpose and context actually is, and then we'll sort of like, jump into a couple of the more interesting ideas. So we're New Zealand's sovereign wealth fund, set up to pre-fund retirement income obligations that sit with the government. So there's universal super in New Zealand. Everyone above the age of 65 gets the same pension. It's not means tested, and it's paid for from this year's tax revenue. So this year's super is paid from this year's tax revenue. So we're essentially a buffer fund. The government's contributing into the fund now, and at some distant point in the future, we'll start sort of like paying down to help meet those retirement income obligations. The mandate's pretty simple: maximize return, don't take too much risk, exercise best practice portfolio management, and try not to compromise New Zealand's reputation while you're doing that. The key thing is that all 3 of those are essentially equal sort of like legs of the same stool, so we don't really favor one over the other. The governance is independent. It's a double layer of separation, if you like. There's an independent board. The board sort of like owns several of the decisions, but has also delegated lots of the decisions down to management. So we definitely operate, at as we call it, the double arm's length from government. All right, so that's the background. Let's start with sort of like, some of the principles around the asset allocation. And what I'm really referring to, because these are like the precursors to the innovation that we sort of like exercise. We've identified 4 endowments: our sovereign status, the long horizon, the operational independence that we have, and the known liquidity profile. So that's useful. We kind of like always start referring back to those endowments that we have, because they're useful for figuring out what's unique or different about us. We recognize we're a relatively small institution, geographically challenged. So what we try and do is somehow differentiate our dollar from the dollars that any other investor might bring as well. So being able to sort of like, reach back to those endowments that we have, and then being able to take those endowments to the people that we want to work with, or, the assets that we want to acquire, that can usually end up, hopefully, in a mutually beneficial outcome. Beliefs, hugely important. They anchor us to a particular worldview, we need to kind of like all decide on that minimum set of things that we believe in and get universal buy-in. And the main purpose that they serve is to make sure that, we're not pulling in opposite directions or compromising decision efficiency. That's not to say that we don't have debate, but what the beliefs do is set the parameters for having that debate. You do want to question them, of course you do, but so long as you do question them and you find that those beliefs are unchanged, those beliefs are incredibly useful for kind of like allowing you the faith and the strength that you need to keep your stomach when things are not really moving in your favor. The last observation I'll make on investment beliefs is that one in particular, a belief that we have around the mean reversion of asset class returns has probably been responsible single-handedly, has been probably responsible for the bulk of the alpha that we've generated over the 17 years that we've been in operation. Right. Let's move on to factor-based investing, because that's two of the ideas that have kind of like come up through both Scott calling it systematic investing. Tanya brought that up as well. So we've been implementing this for 5 years now. The research phase probably took us 5 years before that. And again, this is kind of like coming back to the point that I made at the start, which was that innovation is incremental. And it took a long time because we undertook a very careful evaluation of the literature, and in all honesty, things were probably being written faster than we could read them. So our institutional approach, maybe speaking to our culture, is that we bring everyone along. Legitimately, skepticism arises, and you have to overcome that. But that greater buy-in that you can achieve definitely makes for a more successful long-term strategy. Turning to some of the specifics, in 2016, we sort of like started off again incrementally with a value and a low vol portfolio. Tried to follow somewhat of a sleeved, separate approach so we could better understand exactly what we were getting. We worked with Scott and some of his friends in Chicago to try and understand some of the portfolio mechanics and how these things were developing so that, if at some point we wanted to do this ourselves, we could also sort of like, acquire some of the IP around that. We, in the end, decided to kind of like combine those two portfolios and equally risk weight those. And the other thing that we did was also reduce the carbon content. There's a session tomorrow around climate change, and I can talk a little bit more around how we decarbonized our portfolio and sort of like, what some of the reasoning around that was. At the end today, we're just about complete with taking this factor-based philosophy, and this is only our equity factor-based philosophy, to 20% of the fund's entire NAV. The fund's about 43 billion New Zealand dollars at the moment, which is just about the same, I think, Aussie dollars as well. So at 20%, this is going to be a pretty large chunk. We've added momentum and quality factors into the mix, and we think we're there now. So these are the 4 things that we believe in. Generally have a preference for simple but not simplistic approaches. We try and pay careful attention to monitoring, T costs, figuring out that portfolio implementation and trading are the kinds of things that matter a lot. The last sort of like, I guess, innovative aspect of this that we're kind of like thinking a lot about is that we're trying to monitor the liquidity requirements that these sort of like, having so much of the portfolio sort of like that's dedicated towards these risk factor approaches. What does that actually mean for the liquidity implications that you have? And one of the new things that we're going to try and do is try and implement a lot of these exposures synthetically so that we can try and sort of like, get, rather than via physical, so that we can maintain some of the liquidity requirements that we have. We've also sort of like, I think one of the interesting things about innovation is that we sometimes, when you kind of like look back, you don't always remember the things that have fallen by the wayside. So, yes, equities were there, but we've also looked at this with fixed income. And relatively quickly, at least for us anyway, within a period of about 6 months, decided that sort of like taking the same philosophy to fixed income probably wasn't for us, because it couldn't be reduced into that same simple, systematic way of doing things that we appreciate. It kind of like definitely required a higher level of skill and expertise, and sort of like more careful day-to-day portfolio management than we actually wanted. For an institution that wears ESG on its sleeve, and where ESG is integrated into all aspects of decision making, it was also sort of like a bit of an interesting outcome for us, where we looked at the idea of whether ESG itself was a compensated risk factor. And at least in sort of like phase one of our research, probably ended up concluding that it wasn't. So we will tackle this again, maybe tackle this from a different way, different lens, but we're not quite there yet. And then sort of like the last thing that I really wanted to talk about was, this sort of like I've spoken about, sort of like the risk factor approach is our climate change investment strategy. So having done sort of like a massive amount of research, we do believe that the market currently underprices carbon risk. And since our mandate does say, minimize or avoid undue risk, then we have no obligation but to do something about this. So we see climate change as a market and a policy failure. We think markets are producing too many emissions and are overinvested in fossil fuels given the international context. We believe that carbon risk is underpriced, partly because the time horizon over which the effects manifest are probably too long for market analysts, but it's relevant for the time horizon that definitely matters for the fund. And there is uncertainty around the path that the world will follow, and the different risks have different impacts. So where does the risk actually come from? It comes from the supply and demand changes, from the substitution, from higher cost structures, from consumer preferences, and importantly from regulation. Physical damage and disruption to industries and economies, the inability to adapt to reasonable cost over a reasonable period. So overall, we believe that it presents a risk for which we are not being compensated. So as a result, we've taken fairly strong measures to decarbonize our entire portfolio, including the risk factor part of it that I was talking about earlier. But more generally, we've kind of like started engaging very heavily with all of our portfolio companies on these topics. We've started sort of like even where we make fundamental active sort of like decisions ourselves, trying to sort of like build in very specific and consistent climate change related analysis into drivers of risk and return for each of those assets that we're analyzing. And lastly, we think this presents opportunities as well. So we're always on the lookout for sort of like new ideas and new opportunities that this might throw up. So that essentially is it. That's what I have to say about some of the what supposedly innovative things that we have been doing. So 2 ideas for you to take away today was we are firm believers in risk factor based investing, and we do believe that climate change is consequential, and that that it kind of like is incumbent upon us to do something with our portfolios to accommodate that. But I know that we will have another conversation on that tomorrow as well. That's it. Thank you.
Thank you, Rishab. Now, I'll just encourage everybody, there's microphones going around as well, so if you wanted to have a question live, then please put your hand up and we'll tackle those as well. So just going back to sort of square one, to the start of some of the presentations, back to beliefs, maybe starting with you, Tanya, just around aligning beliefs. What sort of process do you go through to get all of the people necessary to be aligned around the beliefs that then keep you on the straight and narrow for the long term?
So that's a very good question, because there's obviously a whole range of sort of different elements or frameworks around how you think about beliefs. We've certainly gone through a process in which our board and our board investment committee has undertaken very serious consideration of their investment beliefs. And obviously they cascade down to us from an investment perspective, but then there's sort of obviously the broader organisational beliefs. We then have to actually also engage from our client perspective as to their beliefs and ensuring that our portfolios and the way in which we manage those are also aligned with those beliefs. And I think to some extent the beliefs themselves are very important as you actually land on them. But I'd actually argue that it's the process by which you go through trying to define those beliefs that can become as valuable, if not more valuable. Because sometimes it actually challenges both the individuals who are, tasked with these responsibilities, but also, the actual organisations about what are those investment beliefs, because they do have significant implications, and it's thinking through those. So I think it's both actually landing on an outcome and having an agreed set, but it's that process of engagement, and to some extent, as I said, aligning the governance, and that's a very good way in which you align the governance of the organisation, such that you've gone through a process of discussing and really challenging, what are your investment beliefs and what are the implications, the so whats of those for the portfolio.
And we were both in that last session with around culture and diversity and leadership, and I guess this plays also into the recruitment aspects that the beliefs, I presume, are pinned up on the wall, and part of the recruitment process, everybody comes in has to be a believer.
Yeah, I'll always be, probably for those of you who know me, I'm always a little bit controversial. I don't think putting things up on the wall is actually a way in which you really put your beliefs there, clearly communicating them and making them clear, but you have to live them. Organisations that are successful are not about putting things up on walls and sort of putting them out there and saying this is what we do. It's actually how you live them, it's how you deliver them, and it's how the leadership of the organisation actually demonstrate their commitment to those beliefs. And whether that's actually through an investment belief, so actually having your portfolio and the way in which you invest reflect those, or your organisational or cultural beliefs in terms of what really brings value to an organisation or the individual. So, putting things up on walls are helpful, but that's certainly not the way in which you actually gain the benefit of those beliefs.
Yeah, I agree. I think it's a lot of people following will see what the leaders, how they actually, when they get tested, how they respond is when they see whether people are serious about those beliefs or not. So, Rishab, at New Zealand Super Fund, you talked a little bit about reputation, risk, and having faith and strength when things get a bit tough. So is that had a similar approach to how you've managed beliefs in the New Zealand Super Fund?
We've certainly not put them up on the wall. I think I'd go so far as to say is that it's fairly easy to ignore things that are put up on the wall because you kind of see them every day and you kind of forget about them. So just echoing what Tanya said, you kind of have to. We don't expect this of the people when they're kind of coming in on the first day. We don't hire them because they kind of have exactly the same sort of belief set. But yes, over time, as I said, the important thing with beliefs is that they kind of help you pull in the same direction. A simple example, going back to what I was talking about, the one belief that we have, one of the 8 or 9 that we have, but the one belief around the mean reversion of asset class returns, that kind of came in extremely handy for us in the depths of the GFC when we kind of had put in a strategy. The strategy lost money hand over fist in those sort of literally in those very first days. But we asked ourselves, do we believe that anything has fundamentally changed about the world, that we no longer hold this to be self-evident or true? And sort of reaching the end of that exercise, we realized that was not the case. So in effect, it probably actually allowed us to double down on the strategy at exactly the right time and reach some good outcomes for us as a result.
So Scott, just also going to you as a fund manager, you must have had some times where some of the innovative investment opportunities you've worked with have tested your resolve and how that's worked its way through?
Yeah, absolutely. And I think the importance of having very clear investment beliefs, it really just comes back to having a very disciplined process, probably to the point that Rishab made, but making sure that you can adequately judge success and failure as well. So if you have beliefs, if that cascades down through the investment process, it should allow you to actually get the attribution that you're seeking to clarify where things might be consistent or inconsistent. And I think that discipline is extremely helpful to make sure that you're not making rash decisions or being whipsawed within a market, especially when volatility is high. It's very hard to actually make very rational decisions because there's a lot of pressure. But once you can actually articulate those beliefs, you can actually elevate the discussion to things that you can actually control.
We will take a question from the floor now.
From REST, thank you very much for that really interesting frameworks in which to look at your investments. My question is about a little bit related to the heading portfolios of the future. Tanya, you mentioned 3 decades, and I'm a similar vintage, and a lot of us working full-time in investments are about that long. But over that 30 years, and we all use our experience and also data to look where we look back to project into the future. But over those 30 years, interest rates decreasing over that period of time, and I guess like quite a few others thought they'd sort of hit the floor of zero, and that didn't prove to be quite correct. But I don't think they're going to, over the next 30 years, keep on going down to negative 18%. So the future has got to be different to what we've seen in the past. I'm interested in how you're taking account of that different future.
Well, I think maybe I'll go back to a belief, which is that if you want to get reward, you have to take risk. So again, I mean, I think this comes down to, I've heard a number of people, not in this environment, but, saying of the last 10 years, if I knew 10 years ago, what was actually going to happen in the next 10 years, I would have done things differently. Well, of course, that's always going to be the case. And I think with all our collective, wisdom, I think the older you get, the older you get, the more you realise what you don't know. I think it's very hard to know what the future will be like, but all we can do is to use the information that we have, and risk decisions are ultimately, if we have an investment belief that risk is rewarded, and clearly that I think is pivotal to what we're doing. If you were to believe that actually risks, as long as you are really mindful and focused on actually understanding the risks, and I think very much to Rishab's point of view, absolutely understanding those risks, understanding those and making active decisions around what you are accepting in those risks and why you are making those decisions. That is the only thing that we can do. And I think within the set of beliefs is that diversification of risk. Again, investment theory says the only free lunch that we really have is the ability to diversify risks. And so making sure that we are diversified sufficiently in terms of the risks the portfolio we're exposed to is the only and best way that we can position ourselves for the uncertainty of the future.
Any other thoughts? Nope. Factor-based strategies, how do they sit alongside active strategies, and how do they protect against risk going forward? Rishab?
Yeah, I think one of her other beliefs, if you like, is that skill is rare, and not just sort of like in the world out there. We also believe that we ourselves are not especially skilled at identifying skill ex ante, and so what that obviously means is that it kind of like biases us away from what might be considered a whole bunch of active strategies. I think just kind of like coming back to what Scott had said at the start, where we do find some comfort, some strength is from systematic strategies that perhaps combine the best of beta and the best of alpha, but you can sort of like codify them, you can systematize them, you can sort of like develop relatively simple rules-based constructs around which to develop a strategy. We think that the best or the most compelling ideas from these have been tested across time and space. So that works well. That gives us comfort. So yes, so systematic investing, I think we are increasingly big believers in, but that is not at the price of fundamental active strategies that we were never very big believers in.
Are there any asset classes that it's better suited to, or is it just cuts across most asset classes, or is global equities the prime opportunity?
I think no, global equities, both DMs and EMs certainly. We actually think that it is sort of like real with fixed income as well. It's just that with a very small proportion of fixed income in our actual portfolio, we probably want to maintain some of the lubricating advantages that our fixed income allocation gives, so probably don't want to compromise that by moving it too far away from vanilla, if you like. But yeah, I think these things exist in a variety of asset classes, and the next phase of innovation will be really in terms of, we'll be trying to unpack where else we could apply these things.
Tanya, do you have some thoughts as well?
So I think that, again, I mean, we keep coming back to beliefs, which are always very helpful. I mean, certainly our view is that beta is the key driver of outcomes for portfolios. And if indeed you attest to that, then you recognise that that's where you should be focusing certainly a lot of your effort. I think, like Rishab, being humble, understanding that we're probably not that skilled at trying to either pick timing or certainly feel that we're any better at trying to identify opportunities. But the realisation of betas being a predominant driver of portfolio risk and return outcomes is key. Alpha strategies, or sort of active strategies, I think absolutely have a place within a portfolio construct and the way in which we think. But I think it's thinking about where you feel alpha exists. And the more that I think information, data, transparency exists, the more likely it is that some of that will be arbitraged out. So if you think that there are efficient markets and that there's lots and lots of people combing over the same data, then the probability of having high levels of alpha that can contribute to your portfolio is probably going to be more limited. So it's, I think, thinking about where you think active strategies are going to be most useful, and then actually thinking about your team, because it's a very large investment world out there. Many of us operate small teams. We're a team in investment terms of just 50 people. So you can't be thinking that there is alpha everywhere and spending large amounts of your team's capacity in seeking that. So alpha definitely has a role. Beta is probably the predominant thinking, and then really thinking about where you should be hunting for that alpha is probably the key thing for us to decide.
So Scott, in your experience, are there any barriers to taking up innovative ideas, and what do you think needs to change for some funds and managers as well to be more innovative in how they manage these risks and taking up new ideas?
I think the innovation's actually evolving quite a lot. So I mean, relative to when I started my career 20 years ago as an asset consultant researching active managers, I think the tool set and the understanding of risk drivers in portfolios has definitely evolved. And maybe just touching on the role of, I guess, factor-based strategies alongside traditional active strategies. I think often in the industry we kind of we have these opposing views on what the best way is. So whether that's active or passive or factor-based, and I think it's not so much a competition, but actually how do they complement each other. And I think when you look across most portfolios, it's about complementing factor-based strategies with active managers or vice versa, because the skill set and the capabilities are quite different across the two. So from our perspective, we definitely believe that factor-based strategies can be a good complement to either active or passive strategies, and specifically in achieving multiple objectives of portfolios. So if there are things like volatility requirements or other factor exposures that come through, not just at the equity level, but across the portfolio, then systematic or factor-based strategies can be very effective in terms of managing those risks that we're effectively now measuring, which I don't think we have measured well in the past.
So Rishab, there's a bit of interest coming through on the iPad around ESG and how the New Zealand Super Fund has been introducing that, and whether that's had an impact on returns, and how also you're dealing with that being fairly remote.
Yeah, okay, so lots of things. Very quickly, just take you through some of the features, I think, perhaps, of our policy, because it's not even a strategy anymore, it's a policy. As you said, we're essentially required. We also think that it's good practice. It probably began 10, 12, 13 years ago in the classic way of just trying to make sure that we were not actually invested in the things that we shouldn't be invested in. How did we define the things that we shouldn't be invested in? Well, we basically looked at New Zealand legislation for that. So New Zealand's famously been anti-nuclear, anti-whaling. So those kinds of things were relatively straightforward and easy for us to achieve, obviously, from the start. But then, more generally, we've sort of like begun to integrate, as the phrase goes, integrate ESG thinking into all aspects of our investment decision making. We have an extremely strong, very capable, responsible investment team, but whilst once upon a time they might have served as the gatekeepers, as a gauntlet that you had to run to get an investment over the line, for several years now, their role has changed entirely, where they've become essentially, developers of ideas, of educating our own staff. So much so that I think, we would not hesitate to call ourselves at the individual PM level or at the individual analyst level. We would not hesitate to call ourselves, sort of like, RI analysts as well. We've had sort of like that thinking. Sort of like, brought in. It's kind of like sits deep, that RI analysis, if you like, which we think is integral to understanding risk and reward, just sits alongside all of the financial modeling that we might do to understand an asset better. We engage widely. A simple example. This is something that obviously, like, as a New Zealander, I feel very strongly about, but with the horrific events that happened in Christchurch earlier this year, and the role of the social media companies in essentially in not being able to prevent some of the very graphic videos from circulating online. Well, we realized that that us trying to talk to a Facebook or a Google and trying to register sort of like, the abhorrence with which New Zealanders would hold sort of like these videos sort of like being freely available online was just not going to cut it. So, it's excluding a Facebook or excluding a Google from our investments is probably not, it's not going to achieve the right thing. It's not the right thing to do. It's not the sensible thing to do. But what we have managed to do, for example, is set up a collective engagement with several of our friends, and by friends I include our peer institutions. I also include several of the asset managers, both the ones that we work with and the ones that we don't necessarily work with, and essentially, have strength in numbers, have strength in AUM when we go up and talk to these institutions. So these things are, just absolutely central to our investment decision making now.
I think we've got time for one more question. So Tanya, we're talking a bit about risk-adjusted returns, and in a very low yield environment, in fact negative in lots of places in the world, what does that do to a defensive part of a portfolio? And in the same environment, how do we protect against downside returns? You're going into riskier assets to get some yield, but that exposes you to other risks. How do you manage that at the moment? And what do we mean by risk-adjusted returns?
Yes. So again, this comes back to your risk framework. Is if you're sort of having to answer the question of what do we mean by risk-adjusted returns, it's really being understanding very explicitly about what would be the appropriate reward for taking on that risk. As I said, we are in a low return environment, or certainly it appears to be a low return environment, but I think as was said earlier in the discussion, that we've been saying that for a long time. So we can't be sure whether that is or isn't the case. It's making sure that we actually accept the right risks. And those can be sort of really just understanding what cash flow implications are, doing that modelling and really understanding what is going to drive, difference in the outcomes. And I suppose trying to really understand what you are expecting those outcomes to be and run some really extreme scenarios, so that you can say, well, what would be the variability of our expected returns under different environments? And so therefore the robustness of your expected return for that amount of risk. And once you start doing that against different investments that you have within the portfolio, I won't say it becomes easier, but it becomes more comfortable to do that. And again, you're starting to trade off, if you like, capital, compete with the capital or the risk budget that you have, and think about where's the most appropriate place to put those risks. But certainly not necessarily an easy thing to do.
No. Okay, we have run out of time. Our speakers obviously are around, and we're going to be outside in the foyer having lunch in a moment. First of all, I just want to say that there's a donation being made on behalf of the speakers to the First Nations Foundation, which is proudly supported by our event partner, Holding Redlich. So please join me now in thanking our speakers.